Bitcoin didn't lose to gold in 2025 because it failed. It lost because the game itself had changed. And if that game keeps changing in 2026, the outcome could be far more brutal. So in this video, I'm going to dissect the forces that allowed gold and silver to beat Bitcoin last year and look into where the trend is pushing into for 2026. Could metals continue to outperform Bitcoin by an even wider margin this year? Or has the precious metal rally gotten out of hand? Well, let's find out. Before we continue, I'd just like to quickly remind you all to please subscribe to my channel if you find this sort of content valuable. I mean, it helps quite a lot, and most importantly, it signals to me whether or not this sort of content is worthwhile to pursue. So with that being said, let's get back to our video. So looking at this graph, it seems fairly obvious which one out of gold and Bitcoin emerged victorious in 2025. While the S&P 500 has shown some degree of resilience throughout the year, despite all the stresses on the US economy, gold really rocketed last year. Bitcoin, however, was the weakest class amongst these asset classes. And as you can see, the shift really began becoming clear from October onwards. And that's very significant because that's around the same time when the market was focused on a problem in the monetary system, which was, of course, that of liquidity. Look at how the Fed reserves had fallen to such a critical low in October and November, which is about the same time the Bitcoin sell-off had sort of intensified. And then you have this chart, which shows a nearly 80% correlation between the price of Bitcoin and global M2 liquidity. So there's clearly some sort of link between liquidity conditions and how the market values financial instruments such as Bitcoin. In fact, throughout 2025, the Federal Reserve was still running quantitative tightening, which means that the Fed was actively withdrawing liquidity from the system instead of adding to it. Now, the way the Federal Reserve typically does this is by not reinvesting the principal when treasuries and mortgage-backed securities mature. So as the Treasury shifted towards the heavy T-bill issuance, what happened was that the cash began getting pulled out of the system, and quite efficiently. Now what happens immediately is people start selling Bitcoin when the liquidity shortage becomes more apparent. This is because Bitcoin is extremely sensitive to these liquidity dynamics and isn't considered safe at all during periods of such tight liquidity. When the Federal Reserve's balances decline, there's less money available for riskier assets. Now, Bitcoin, being highly volatile and speculative, gets hit harder than stocks in such conditions. Stocks, on the other hand, can partially withstand tight liquidity if margin balances remain high, because investors can still trade using leverage. This means that even when overall cash in the system is scarce, equity investors have the ability to borrow, to maintain, or even increase their positions, providing some support to stock prices. Now, compared to that, Bitcoin doesn't have this level of institutional support, or any sort of leverage buffer for that matter. So when liquidity does dry up, its price drops sharply. So almost immediately, the level of buying drastically comes to a slowdown. Now, to make things worse, market participants are no longer thinking of long-term upside in such a situation, and instead they're focused more on cash management. So Bitcoin, which has had quite the run-up in recent years, is usually the first asset institutions sell. I mean, it kind of makes sense because Bitcoin isn't generating cash like other financial assets in the market. Neither can it serve as collateral in most traditional funding markets, and most critically, it really doesn't help institutions meet their short-term obligations. Furthermore, when the market starts liquidating Bitcoin, its price takes on a drop, which then reduces overall risk appetite for Bitcoin, and this further leads to even more selling and weaker sentiment. So overall, this negative feedback loop brings even less willingness to deploy capital towards Bitcoin. Now, at the same time, as we all know, precious metals like gold, silver, and copper have been performing really well in recent years. And their winning trend seems to actually have accelerated with Bitcoin sell-off. Gold in particular acts as a safe haven asset and a reliable store of value when confidence in traditional financial systems erodes. So obviously there was a lot of this capital transfer from high-risk plays such as cryptocurrency to more secure stores of value such as gold, which have no counterparty risk. And it's incredibly liquid and also a great hedge against inflation. In addition to these liquidity stresses, gold, along with other metals, also face strong tailwinds in the form of an extremely volatile and uncertain geopolitical landscape and massive industrial demand, all of which are collectively adding to the robust price climb we've been seeing lately. This now leads us to the million-dollar question, of course, which is that, is gold going to outperform Bitcoin in 2026 as well? So to answer this question, we'd need to know what the macro liquidity picture this year is going to look like. And obviously, none of us can foretell the future, but we can get some idea by looking at the key drivers that markets are already signaling. And looking at these signals, the answer seems to be, well, complicated. On the one hand, there does seem to be consensus among economists and financial analysts that liquidity conditions in 2026 are expected to generally improve and transition towards a more supportive state. We know this because most major economies are showing inflation moving closer to target levels. In fact, the IMF recently pointed out an easing of global inflation, which was 4.1% in 2025, while projections for 2026 are 3.8% and 3.4% in 2027. Now, similarly, the global economy has surprisingly shown quite the resilience to the tariff shock that many feared would meaningfully derail growth. Now, despite elevated trade tensions and episodic escalations, global output has continued to expand at a steady pace, with even the IMF revising global growth upwards from 3.1% to 3.3%. So broadly speaking, given this macroeconomic trend we are seeing, central banks are likely to approach the low point of the current rate cutting cycle. So I believe there is going to be a gradual improvement in the liquidity situation in the markets. But crucially, we need to keep in mind here that an improving liquidity backdrop does not automatically mean a return to the kind of excess liquidity that historically turbocharged Bitcoin in the 2010s. Based on what large liquidity managers themselves are signaling, 2026 looks less like a new era of abundance and more like a plateau. The folks over at JP Morgan and at TD Economics have mentioned that the Fed may maintain interest rates between 3.5% and 3.75% throughout 2026, while some even suggest that a slight hike may be possible if inflation remains sticky. So a return to the really loose conditions of the 2010s of nearly 0% interest rates seems almost impossible right now, and many economists actually treat that time as a sort of historical anomaly. So I do expect liquidity to improve at the margins this year, but not to the degree where we'll see cash flooding the system as it did in the pre-COVID years. And without that flood, the speculative impulse that Bitcoin tends to rely on struggles to fully reassert itself. So we can expect Bitcoin to stabilize somewhat and take on a slower growth rate this year, but nothing like the historic boom cycles we've seen in the past. Now, gold is a completely different story. Unlike Bitcoin, these commodities don't exactly need excess liquidity to thrive, and in fact could show a lot more resilience than Bitcoin. There are two main reasons as to why I say this. First of all, gold's safe haven nature is almost undeniable. When investors sense uncertainty, whether it's around growth, geopolitics, or policy credibility, gold tends to attract capital almost immediately. Right now, with so many political flashpoints around the world, whether it's Iran, Greenland, Ukraine, or the Middle East, investors are not short of reasons to think about hedges. These uncertainties are further amplified by President Trump's tariff policies against historically major trade partners such as South Korea, France, India, and others. Now, on top of all of that, President Trump is expected to announce his pick for the next chairman for the Federal Reserve after his very public disagreements with the current chair, Jerome Powell. So the current chairman's term is going to expire in May, and prediction markets currently show a strong leading probability for BlackRock's Rick Ryder to become the next Fed chair. Ryder is seen as more dovish than other contenders, which means that the market expects him to lean towards lower rates compared to the recent stance seen at the Fed. So all this uncertainty on its own provides gold with the fuel to keep rising beyond its current levels. So this geopolitical angle was the first major structural support for gold. The second catalyst to consider is that central banks from emerging economies have been heavily stacking up on their gold reserves in recent years, with China, India, Russia, Brazil, and Turkey really doubling down on their gold acquisitions as a way to diversify away from the US dollar as a reserve asset. Now, this, of course, establishes a sort of permanent floor for gold prices, or as a baseline demand level that doesn't disappear even when market sentiment wavers. What makes this particularly powerful is that central bank demand is structural, not speculative. So unlike Bitcoin, whose price moves largely with liquidity flows and risk appetite, gold purchases by sovereign entities are deliberate, long-term, and very strategic. They provide a steady, predictable source of buying pressure that can absorb shocks from other markets. So in conclusion, looking ahead to 2026, Bitcoin is likely to see modest gains as liquidity may improve slightly, but I don't see it returning to the extreme abundance that fueled its past booms. In contrast, gold seems to stand on much firmer ground because of ongoing geopolitical uncertainty, rising central bank accumulation, and also its safe haven appeal. All of these create structural support that doesn't depend on speculative capital. So for investors seeking resilience and upside in the year ahead, gold clearly emerges as the stronger pick, while Bitcoin remains vulnerable to liquidity swings and risk-off sentiment.